Welcome to Capital Currents, where the flow of daily business news and market trends keeps you ahead of the tide. I'm your watchdog, and today is Monday, August 12th. The Paris 2024 Olympics concluded on Sunday with a memorable closing ceremony which featured Tom Cruise performing a daredevil stunt to symbolize the passing of the Olympic torch to Destination Hollywood in 2028. Today on the docket, we have Paramount Global cutting 15% of its global workforce, Coca-Cola facing issues with the IRS, and Google is back with more negative PR just days after a judge ruled against the tech giant for antitrust practices in their search business. We begin with Paramount Global, which is executing a significant savings plan that includes cutting about 15% of its US workforce. This move is part of a broader strategy to achieve $500 million in annual cost savings, aligning with the ongoing $8 billion merger discussions with Skydance Media. This company has been in the news so much lately after so many other failed merger attempts. They were in talks about merging with Zaslav's Warner Brothers in December, but ended talks in February. They tried merging with NBC Universal's Peacock in May to no avail. Sony officially said they aren't interested 4 days ago. In fact, they were already going to merge with Skydance in June after ousting former CEO Bob Bakish in April. The pressure mounted for Paramount's directors to accept or reject a takeover bid by David Ellison's Skydance Media, who, by the way, is former CEO of Oracle Larry Ellison's son. Lawyers and bankers for both sides were up at dawn to finish last-minute paperwork before the meeting. But literal minutes before the meeting, the Skydance CEO and others received a bombshell via email pulling the plug. Fast forward a few months later, and it looks like the deal is finally back on. The workforce reduction will primarily affect marketing, finance, and legal departments. Despite missing expectations for revenues and subscriber growth, Paramount made progress in profitability, which lifted its stock nearly 6% in this morning's pre-market trading. I'm sure this won't be the last time we talk about Paramount on the show. Coca-Cola is facing some problems with the IRS. A decade-long dispute between Coca-Cola and the US tax authorities has escalated to the point that the company could owe $16 billion in back taxes, enough to wipe out a year and a half of profits. The soft drink maker has been hiding profits in low-tax countries such as Ireland to shield it from the US. Coke will have to pay an initial $6 billion in cash to cover unpaid taxes and interest for the years 2007 to 2009. However, under advice from their auditor Ernst & Young, the remaining $10 billion does not need to be paid if the court ruling goes in their favor. The stakes are high for the US government to recover these funds for two reasons. One, the total $16 billion could cover the IRS budget for a full year. Two, this decision could be a template for the IRS to audit other US companies with profitable subsidiaries. Google is back on my radar with more negative PR, this time dealing with data for users under 18 years old. The Financial Times reported that Google and Meta were secretly working on a YouTube ad campaign to market Instagram to teenagers. Now the thing is, Google has rules against advertising to children on YouTube, but the companies found a loophole. These Instagram ads were labeled as unknown in the advertising system. Even though Google had a high degree of confidence that the unknown group was full of younger users, which are people under the age of 18. To make it worse, this is happening while Zuck testified to Congress about the abuse of minors on its own platforms earlier this year, so it's not a good look for these two tech giants. In other news, Amazon is teaming up with TikTok in a groundbreaking partnership that allows users to purchase items directly from Amazon ads without leaving the TikTok app. This collaboration enhances Amazon's presence on social media, complementing its existing arrangements with Pinterest, Meta, and Snap. This integration allows users to link their social media accounts to their Amazon profiles, making checkout within the app more seamless and efficient. That's all the business headlines I have for you. Let's take a look at some stocks this morning. Friday saw the S&P and Nasdaq both jump more than 2%, with the S&P experiencing its best day since November 2022. Crazy to think that this time Monday last week, investors thought the sky was falling. This surge was driven by a better-than-expected jobless claims data, 233,000 new claims compared to the expected 240,000, indicating a potentially stronger than anticipated labor market. Bitcoin has also rebounded above 60,000, adding to the market's overall positive tone. Taiwan Semiconductor TSM reported impressive July sales, up 44.7% year over year, driven by growing demand for AI chips. No surprise there. This strong performance underscores the semiconductor's giant critical role in supplying major tech companies like Apple, Nvidia, and AMD. Shares are Sweetgreen or big after the salad chain reported a beat on revenue and lifted its outlook for the full year. Same-store sales for Sweetgreen jumped 9% last quarter, well ahead of estimates. And not only is Sweetgreen selling more salads, but they're also losing less money. Quarterly losses narrowed to $14.5 million, down from the $27.3 million a year ago. So yeah, they're still selling $16 salads and somehow aren't profitable, but investors are liking the progress the company is making. And it seems like some of the new menu items, like the steak offerings, are bringing people to its restaurants. Sweetgreen stock is up more than 25% in the pre-market at the time of this recording, and the stock is up more than 130% since the start of the year. Now, an example to show even good news might not be good enough. e.l.f. Beauty is on my list of the biggest movers of the day pre-market. Despite a better than expected fiscal Q1 financial print, e.l.f. is down 10% as its fiscal year 2025 earnings outlook fell short of expectation. Wall Street had higher expectations for e.l.f. when it comes to their guidance. On top of that, revenues drew by 50% to $324 million, and e.l.f. now expects to make around $1.3 billion in sales for fiscal 2025 compared to the expected $1.9 billion. That's all for today's show. Keep navigating those waters and see you tomorrow.